Hey everyone, this is Troy Eckard with Eckard Land and Acquisition. Today is January the 6th, 2022. I'm going to give you a market update. Right now, as the closing bell starts to approach today, we're looking at about $79 to $80 per barrel for West Texas Intermediate oil prices. Natural gas is trading around $3.71 per thousand cubic feet. Really what's going on behind the numbers, though, is more important to me than what today's prices are. What we're seeing is an enormous increase in exported LNG, liquid natural gas, to Europe and to other countries. That's continued to keep the demand for natural gas very high. What we're also seeing in the crude oil market is a temporary, and I think it was artificially inflated or artificially positioned in the market, was this new variant of Omicron that was out since about the beginning of December through now. And that has caused everybody to start seeing canceled flights, less jet fuel, and the presumption that there was going to be less demand for crude oil and energy from the fossil fuel sector. In fact, that's not true. Think about it from a conspiracy theory perspective. If Biden tries to ask Saudi Arabia and Russia to produce more oil and they say no thank you, and oil prices and gas prices continue to increase, inflation is going through the roof, what better way to slow the economy down and the disaster of inflation and the disaster of rising energy costs by then scaring people back into lockdowns, which has not worked. So what we saw from about the beginning of December through about 3 or 4 days ago was an effective reduction in the price of crude oil by the traders, assuming there'd be less demand because of this new variant. When you stop messing around with the media and you stop thinking about what goes on behind the scenes, what you really have is fundamentals. And the fundamentals are very simple. Over the last 24 months, the oil and gas companies spent all of their free cash flow completing and drilling only the very best wells with the lowest cost basis. What is the lowest cost basis to an oil and gas production company? Those are wells that have been drilled and not yet completed. They're called DUCs. And what they did was they took all their cash flow, they went to the field, and they identified their very best, highest priority, drilled uncompleted wells, and began to frack them and complete them as fast as they can. When they did that, it allowed the oil and gas supply side to maintain the level. Right now it's running about 11.4 million barrels a day. It's still 1.5 to 1.6 million barrels below where we were at in total production in 2020. And that 11.4 million barrels a day has only been sustained because of the quick access and the easy bringing to market production from drilled uncompleted wells. Well, that inventory has shrunk. Now we're starting to see less and less drilled uncompleted wells available. The oil companies are now forced to drill brand new wells, which is why we're at 580 rigs active. And the fact of the matter is, unless there's new capital coming in, we're not going to see this quick to market, quick to supply drilled uncompleted wells as a possible solution. And you're going to start to see a lot of pressure between supply and demand. Now, one other thing I want to add to today's market report. Several companies are reporting that they are not going to hedge their oil for 2022 or 2023. What they're indicating is that the difference between the price that they put their supply at, let's say last year was $55 a barrel, and what the real market paid, which was $70 to $80 a barrel, it cost them several $billion in profit they were not able to participate in. These companies and their CEOs and CFOs are now clearly indicating that they are not going to hedge because they believe the probability of much higher commodity prices, both in terms of oil, liquid natural gas, is going to be much higher, and they don't want to lose all that upside profit by hedging their oil. That is a clear indication both their lenders, their financial prowess, and of course their own anticipation of what prices are going to be more leaning toward the upside than the downside, and they don't want to lose that profit. What does that really mean to you and I? All the indicators from the market, the lack of capital, the lack of hedging, is that we're clearly on a path to much, much higher oil prices than we are today. And I still hold true that I believe oil price will end up between $95 and $100+ a barrel this year, with natural gas averaging $4 to $6 per thousand cubic feet. Off to a great start this year, ladies and gentlemen. Prices are good, gas is good, our wells are coming online, but more importantly is commodity prices are responding exactly like they should, which is core fundamental economics. We have a lot of consumption, less supply, very tight supply chains, and that means only one thing: rising prices. Troy Eckard with Eckard Land and Acquisition, January 6th, signing off. Take care.